All right, everyone, we got markets higher right now, up 207 points, right near the highs of the session. Nice to have a little good news out there today. And I'll tell you, this is happening despite the release of new economic data showing that, yes, inflation has picked up in the last month, but maybe that's okay. At least the market's saying that today. Joining me right now, Wall Street Journal Global Economics Editor John Hilsenrath, along with Money Map Press Chief Strategist Keith Fitz-Gerald. Hey, guys, can we take a look at the 10-year yield here? Because this has been creeping up higher, and there's an expectation that basically 3% is going to be the new normal. I think they're working on that, but we're hovering around 3% right now. John, 3%. Any reason to worry about that?
Well, I mean, in a normal world, that would be a very low interest rate, but rates have been much lower than that for the last few years, you know, below 2% at points. And so I think the market is taking some adjustment, going through an adjustment period to get used to this, this return to normalcy, so to speak. So that adjustment is some cause for worry, but if it happens smoothly, then the markets ought to get back to normal.
Okay, we do have the 10-year for you. Let's take a peek. Okay, 2.89%. So, you know, a little bit lower today, but nonetheless, 3% could very much be within shot, certainly sometime within the next 6 months or so. What does that do to the Fed and their willingness to raise right now, Keith?
Well, I tell you, there's two things that are going to happen. Number one, it forces the Fed to look at the models it's using, and it forces traders to look at the Fed by virtue of the models they use. Let's not forget that 70, 80, 90% of all the trading today in global markets is computerized. And what they're trying to do is they're trying to remove that risk from the equation. So when you have a fast interest rate movement, like we've seen over the last couple of weeks, you have computers that duke it out. That's why you have the huge swings in volatility that we've seen. As that calms down, it's like a ripple, or, you know, in a pond. It calms down, it becomes glass smooth. Traders get back to fundamentals. What I've counseled investors to do is think about the CEOs, because they don't play with models, they play with real money. And as long as their guidance is good, their numbers are good, and their earnings are strong, then that's where you need to be paying attention.
All right, go ahead, and then I got a question for you, John, but go ahead.
Sure. I was just going to make one point that, you know, this rise in long-term interest rates and the volatility that we've seen in stocks and the declines we saw in stocks a week ago, in some ways take pressure off of the Fed, because the Fed had been raising interest rates, and it had not been seeing financial conditions get any more restrictive, and that put pressure on them to move more aggressively. Financial conditions are now becoming more restrictive because long-term interest rates are going up. So the Fed is seeing the kinds of reactions in markets that it would expect. That takes a little bit of pressure off them. I don't think the Fed is going to look at what's going on in the markets right now and dramatically change the way it's responding to the economy.
Well, it should be looking at the inflation data, really. I mean, I don't like the idea of the Fed looking so aggressively at the markets anyway, because then you can have all the taper tantrums, I should say, you want, and the Fed should be a little bit more of the parent, shall we say, in this situation. Yeah. But let me ask you this, John. Because this is, you know, this is the fear, right? And by the way, I should point out that for the last decade, every time I went to do a panel, at least for like the first, 5 years of the mess, and I would talk to investors, everybody would tell me, oh, well, there's this great rotation. It's coming any day. Believe me, we are getting inflation that's going to be runaway. It's going to be crazy. And, this is going to be a huge, huge problem. Well, they said this, they said this, they said this, and yet the market kept ticking higher and higher and higher. It never came to fruition. Right. So, John, I'm very hopeful it never comes to fruition, and that, in fact, we're able to contain this inflation and that it's modest. But what does it do to the economic environment if, for example, suddenly mortgage rates are much higher and people can't, take out as big a mortgage because they can't afford as big a monthly payment? And suddenly housing, which so many Americans are invested in, starts to suffer.
Well, I mean, you put your finger on one of the aspects of rising interest rates that is really important. So the first place we look at are interest rate sensitive parts of the economy, and housing is the most interest sensitive. Autos is another area that's highly interest rate sensitive. So if rates go up a lot, then yes, it is going to hit the housing expansion that we've got. Having said that, inflation tends to be a very slow-moving process, And we've had inflation that's run below the Fed's 2% target for 5 years now. You know, if it runs a little bit above it for a little while, I don't think that's the end of the world. The question is, looking a year or 2 years down the road, does this process get out of the Fed's control, and does it need to move rates up even more than it had planned to try to wring inflation back down to 2%? That's something that's going to happen very slowly. It's not going to happen overnight. We're going to have a lot of time to look at data and to adjust to this.
Yeah, I hope you're right. And I think that this is one of those things that you can sort of see coming, and it should be gradual. Keith, your thoughts?
Well, I was going to say, you know, this is the single most telegraphed rate increase in recorded history. Sure. Team Yellen was very specific about this. If anybody doesn't know this is coming at this point, they have clearly not been living on the same planet as the rest of us.
I'm going to stop you there. I'm sorry, but I have to. Why do they tell us everything, Keith? I mean, what happened to having a little mystery in life? Why does the Fed go out there and signal and signal and signal? No, I'm serious, right? Because you think back to the 1970s. You couldn't even figure out what the Fed had done. There was no press release. There was no press conference. And it really wasn't until Greenspan that we started, you know, hearing a little bit more from the Fed. And then that changed, obviously, Bernanke and Yellen, et cetera. But there was a time when Fed watchers really mattered. And there was a time when an investor had to make a bet based on fundamentals instead of what the Federal Reserve was going to do, Keith.
You have the internet and modern technology to thank for that. The Fed, like every other company, agency, political agency out there, wants to communicate. They want to be transparent. I mean, that's a word I love to hate in today's era because it confuses things. So the dictionary for Fed speak is very different from the dictionary of real money. And again, if you follow the real money, you will know where the profits are. So the Fed, I would submit, respectfully so, is almost irrelevant at this point. What you want is to watch the global traders who have to move that real money every single day because they're the ones who are assessing the risk and reward associated with the Fed's target rate.
Okay.
Hey, Trish, can I make one point about that? I don't think there's anything wrong with the Fed telegraphing what it expects to do over the next few months or even years. You know, that's transparency, and that's not a bad thing. The problem is when the Fed gets locked into these expectations that it sets and isn't prepared to change course when events change. So in 2004 to 2006, the Fed got locked into a path of very gradual interest rate increases, and then they didn't adjust when we got a housing bubble. The question now is the Fed going to get locked into the path that they've got of gradual interest rate increases?
I sure hope not.
And are they going to not respond to new developments? And one of these new developments might be inflation that's picking up or an economy that overheats.
They need to stay flexible. A little more real world, a little less academic. Anyway, it's great to see you guys. Thank you for putting it all in perspective, John and Keith.